Okay, this is not an assignment problem, not a homework problem, but it's really good for everyone to kind of understand so that you know what you're looking for if you're ever researching companies in different countries. Now, this would appear on page 4 of the study guide, and it's underneath taxation. It says example of taxation differences impacting net income comparisons. So let's say, for purposes of these financial statements, one company is a German company and one is a US company. In Germany, whatever you use for your income taxes as far as depreciation goes, you must also use in your financial statements. However, in the United States, we have different rules. You can use an accelerated method for determining your depreciation in the US in your tax return, and you can use the straight line method in your financial statements. So let's look at the tax return. We're going to assume the exact same thing for both companies to make the comparison easier. So this is Germany's financial statement, the company, their financial statement, and this is the US company's income tax return statement. As you can see, they have the same revenue, $1 million. Their expenses are $700,000, which means their earnings before taxes are $300,000. Their tax rate, we're going to assume the same for both, at 34%. So what we would do there is take the $300,000, multiply it by 34%, and that would give us $102,000 in taxes. So the net income is $198,000. Now this is what it would look like for the U.S. company's income tax return, and this is what it's going to look like for that German company for their income tax return and their financial statements, because they must use the same depreciation calculation for both. However, in the U.S., remember I mentioned, we have different rules. We can use an accelerated method of depreciation for our taxes to get a lower earnings before taxes, which in turn means we in the U.S. are paying lower income taxes. So let's look at the U.S. company's financial statements. Revenue's the same, $1 million. Here, our expenses are less. They're $650,000 because we didn't use the accelerated method for depreciation. We used a straight line method, which gave us lower expenses. So if you subtract that $650,000 from $1 million, we get earnings before taxes of $350,000. We already calculated our taxes on our income tax return. That was $102,000. So if we subtract those taxes from our earnings before taxes, we end up with net income of $248,000. If you were reviewing an annual report for this U.S. company and this German company who had exactly the same information during the year, you would naturally think the U.S. company did better because they have higher net income. So that's the reason I wanted to show you this example. You have to be careful that if you are comparing annual reports or yearly financial statements for a company in the U.S. compared to a company in another country, you must know their rules, all their rules, so that you can make an educated comparison. If not, you might assume a U.S. company is doing better than they are because of the way we are allowed to calculate our tax returns in the U.S. compared to other countries.